We're getting ready, folks. Hang in there a second. We are live and we are going to just get started in 1 second. 3, 2, 1. Hey, welcome. I'm Mitch Goldberg. This is your post-market show about personal finance, the stock market, trading, investing, everything that could help you be the boss of your money. That's why I call this live stream Be the Boss of Your Money. It's all about helping you figure out the best ways for you specifically to be the boss of your money. I just want you, man, I'm redundant here. I want you to be the boss of your money. And it's not as easy as it sounds because it's very easy for money to become the boss of you. Life throws us a few curveballs, things get in the way, life gets messy, life gets complicated, and we focus on certain things, distractions, hobbies, passions, but we need to really focus on some of the personal finance stuff. We're doing things a little bit different today, and that, I mean, we're lacking something. There's no Facebook today, so I usually stream to my Facebook personal page and my business page. So today we're just on LinkedIn and YouTube. Okay, Josh is out there. Hey, buddy. Hey, Josh, did you change your? Oh, well, you're coming in from YouTube. I got you. So it's a different profile picture. I got you. You threw a curveball at me there. Okay, thanks, buddy. It's nice to see you. So we've got a couple of things to talk about. So, do you buy and die? Do you sell and go away? Buy or sell? This is like confusing. This is one of the most confusing times I've ever seen for investors. I want to help break it down a little bit, put it in perspective, because once I do that, I think it'll start to be more clear to you. I don't think it's I think the answer to everything going on now is patience. By the way, if I'm coming out loud and clear, let me know. Give me a thumbs up or something. Let me know you can hear me just fine. And later on, I'll be hopefully getting posting this to Facebook later. Facebook has been down all day. WhatsApp and Instagram. So I'm very active on Instagram and Facebook. So I just am not able to stream to those at the moment. And is Facebook still up there? Okay, I'll try to get it out there. As we speak, I'm trying to push this out. Nope. Still no Facebook. Okay, so whatever. Screw them. We'll just have to go on with the show. All right. So confusion reigns supreme. Let's look at a couple of good things first. COVID cases are on the wane. They're coming down. What follows is hospitalizations go down and then deaths go down, even though the United States last week reached the grim and sad number of 700,000 known deaths from COVID. I say known because it's well known that the official count, which is maintained by Johns Hopkins University, has said, they've missed a lot. There's probably a lot more COVID deaths out there than have been officially diagnosed. Whatever. It's just a very sad number. I don't want to harp on it, but we have to take a look at that, because what's happening now is, while you're seeing wrangling over the debt ceiling, and I'm going to get into what that is in a moment, and while you're seeing oil go up and inflation worries, we are getting back into the reopening of the economy. And just to give you an idea of how you can follow this in the stock market, we'll talk about this in a moment, but Pfizer, Moderna, the two heavyweights of COVID vaccines. I don't want to even bother saying the Johnson & Johnson one, but the world is awash in COVID vaccines all of a sudden, and these stocks are tanking, if you haven't noticed. So let's do a quick recap of the day. I've got a lot of notes to get through today, so let's start with the recap. We'll do the share screen first. prop myself up in the corner. I'll make it's Mike Santoli doing his thing, but I'm going to make this a little bigger so you don't see Mike anymore. Okay, boom. All right. So the Dow was down 323 points. It was down a lot more earlier in the day, and it's no big deal. Listen, it was down less than 1%. I think this is more of an aftershock. Now, this past Friday, we had that nice, big, terrific, strong rally. And what did I say the day before? Like it's like right on cue. I don't like to see these giant 500, 600 point, 400 point rallies after a big down market, a big down day or down week, because they don't stick. You know, you have the up 500, you know, the next day it's down again. It always follows form. I don't like it. So I know we don't always get what we want. You don't always get what you want. That's a Rolling Stone song, right? Yeah. I'm sorry, I hurt your ears singing to you. But that's what pops into my mind when you hear the expression. You don't always get what you want, but if you try, sometimes you get what you need. I don't have my pad, so I can't make the funny sounds and the but a bump drums and stuff like that right now. Uh, so, but that's why I don't like these big up days followed, because they're always followed by a down day. And that's exactly what happened today. Okay, Dow down 323 points. NASDAQ was the loser of the day, down over 2%, down 311 points. And S&P down 1.3%. And it's usually like that. The Dow on a down day, the NASDAQ is down the most, the S&P is in the middle, and the Dow is down the least. Not to say that they're all down, that they're not all down. Gold is up a little bit, up $10 the ounce. Big deal. Still under $1,800 an ounce. I still am. I feel like are we getting mixed signals from gold? Gold is telling us that inflation is not a problem. That too much money printing is not a problem. That's the message. I'm just the messenger here. Don't shoot me. Okay. I know some of you are like, oh, gold's got to go up. We got to buy gold, and the dollar is weaker and whatever. We'll see what happens if we default on the debt limit. I think October 17th is, according to Janet Yellen, Secretary of the Treasury. That's the drop dead date for when the United States actually runs out of money and can't pay its bills and defaults on Treasury securities, which is supposed to never ever happen because we have the power of the printing press. So we'll talk about that in a moment. The 10-year yield last week, it was like 1.55, 1.56. Now it's 1.48. The VIX was up. Actually, the VIX was up 1.81. It was up more than that. It was up a good deal more than that. But the VIX is only 22.96. Let's call it 23. That's this number over here. Okay. You see that? That's a 23. And if you're listening to this, not watching this, I'll make sure I say the numbers. But that's not as bad as I would have expected. The VIX is hanging in there pretty good, and it's telling me that this bout of volatility, as of now, is expected to dissipate, clear the decks. Okay, let's go on a little bit more. You notice I have a green mouse if you are watching this, the cursor. Just makes it easier for you and me to see what we're looking at. The Russell 2000 was off 1%, kind of in line with the other major averages. And let's just go to another screen. Now, crypto, have you noticed Bitcoin has had this silent rally? It was like 41, 42,000 when China said crypto is banned except for their own central currency crypto. But crypto basically is banned. No mining, no trading, no playing with it, nothing, just no more. And crypto has gone from about 41,000 to 49,000 in a very stealthy way. And a lot of people said, this is it. This is terrible. And, but you know what happened? Gary Gensler, chairman of the SEC, was grilled by Congress. And they asked him, why aren't we getting into these innovations? We want to be ahead of the innovation curve, not behind it. We're not taking our lead from China. China banned it, but that doesn't mean we have to. And he said, you know what? I'm not banning it. I think there's innovation here that's worthwhile exploring, but we're going to regulate it. And once people realized that, once investors saw that we're not going to ban it here in the United States, Bitcoin and other cryptos hit, caught bids and went up. Ethereum also went up. Let me just check on that. See, Ethereum, that was down. Here it is, 33.97. That was like down to like 2,800, 2,600. And I always have to look at the joke of them all. Dogecoin, 24. Dogecoin could go up and you say, oh, some joke, bitch, haha. But sometimes short term, the wrong things go up, and that's just the way life is. Okay. This is why I don't make price predictions on crypto. This is why I talk about it, but I'm not here to guide you into and out of crypto. I'm not the expert on crypto. I think I know more about crypto than most people. It's something I study and I've talked about here on the show so many times. I've created so much content. I've created so much content about crypto, but nevertheless, if you like it, there's nothing wrong with giving it a shot if you have the risk tolerance and the money to burn. Let's take a look at the big story of the day. Facebook. Holy schmagegi. Facebook down almost 5%, but 384 recently. That's like a $38 stock going down to 32. That's a pretty big hit. What the hell is going on with Facebook? And if you compare it to a totally different kind of company, Southwest Airlines is going up, taking off, no pun intended. And the Facebook is not, but all the tech stocks have been getting slammed, and the reopening play is coming back into vogue, like Southwest Airlines. So what the hell's going on with Facebook? So it's time to switch cameras and talk about Facebook for a moment. There is a whistleblower, and she took documents from Facebook, showed them to the Wall Street Journal, and said, Facebook internally knows that 1 out of 3 adolescent age females have negative view of body type and other deleterious things or bad things about what Facebook, what Instagram does to young minds. And the thinking goes that although Facebook, parent of Instagram, looks into this, they're not fully looking into it. They don't want to fully go there and explore what's really happening. They're not taking steps to correct things. Look, as a parent of adolescents, I can tell you there are times when adolescents have a negative view of themselves, of their body type. I mean, that's just, I was an adolescent too. This is just life. But Instagram for young people really, for a lot of people, magnifies this. It's like, is my happy moment in life worthwhile if it's not like a cool Instagram post, and if I don't get a bunch of likes and comments, then was it worth it? And it's hard to beat that dopamine hit of getting views and likes and comments for a lot of people. All right. So I post on social media even if I get no views and people hate my content. So I don't really care. You see how unaffected I am? But this is serious stuff. And now that it's out, and Congress, specifically Senator Blumenthal from Connecticut, said to Facebook, you better hold off on creating an Instagram app for children, because basically we don't trust you to monitor it, and we are worried about what this is going to do to the mental health for children, and you've already done enough to screw up the mental health of adolescents. That's basically the message. So this is kind of a damning report, what's happening with Facebook, that they basically know about how bad Instagram could be for young people. There are suicides attached to it. This is just really awful stuff. Did they raise or lower teen suicide? Probably raised it, and it's really damning. I mean, this is like as bad as you get. So Facebook is coming down. I have clients in huge gains in Facebook, and some clients, we for the right client, if you had to take a little off the table, we did. But it's a really big conundrum now. Um, if you think about it, it's not just Facebook going down; it's all of the FANG stocks that are going down too. So this is a big news. So let me go back to screen one. All right. So let's take a look at another watch list. Let me pop myself up here, and let's take a look at the FANG M stocks. FANG M. We talk about this a lot. Facebook, Apple, Amazon, Nvidia, Google, and Microsoft. I didn't say Netflix because I replaced Netflix with Nvidia. All right. But Apple is down 2.5%, Amazon down almost 3, Facebook down almost 5%, Google down over 2, Microsoft over 2%, and Nvidia down almost 5. As a matter of fact, Nvidia was down just about the same percentage wise as Facebook, and Nvidia didn't really have any bad news to speak of. It's just the vagaries of the market. People are taking profits on um, high duration stocks. I mean, stocks with high valuation metrics. And then you go to the reopening stocks today. Yeah, they were down, but um, these stocks have had big moves recently, especially one of them we've been talking about a lot here is Southwest Airlines. All right. So those are two of the charts that I wanted to show you. I like to close some screens if I'm not using them. Let's go over here and let's just take a look at the sectors. I'm going to blow off the screen here. Oh, here it is. Okay. All right. So who are the winners? Energy continues to be a winner. All right. Utilities, we're up today. Stable, safe area, dividends. Not necessarily safe. I don't want to say that with stocks, but utilities are typically known to be lower volatility. Uh, and real estate was up a drop. Consumer staples barely down. But look at this. Technology continues to lead the way down. Listen, every day was technology was leading the way up. And the issue is the bank stocks have been doing well lately. Energy stocks have been doing well lately. But if you take a look like at Facebook right now, Facebook has a market cap of about $935 billion. That's even after the hit that they just took on Monday. Still a $935 billion market cap. And if you take a look at JP Morgan, for example, one of the biggest bank, JP Morgan's market cap, $498 billion. So as bad as Facebook has been the last week or so, it's still double the size of JP Morgan. So the point is when these large cap tech stocks go down and you have other stocks going up like financials or energy stocks, it's not enough to counter that. The market still goes down because the market caps, the size of the companies and technology going down, just it's like a vortex. It just pulls everything down with it. Okay, so I'm going to show you something real quick. Okay, this is the QQQ. This is the big ETF that tracks the that tracks the Nasdaq 100. All right, it was down 2.1%. Nasdaq 100. But if we just look at the Nasdaq, that was down 2.14%. Okay, so down 2.10 versus down 2.14, basically the same. And it just goes to show you that the rest of the stocks in the Nasdaq don't really matter a whole hell of a lot because it's just the top 100, really, to me, the top 15 or 20 that make all the difference. And everything else, it's just filler. Just wanted you to see a view of that. All right. So what else do we have here? The reopening stocks are starting to take off. Let's look at Pfizer. We've got to look at Pfizer. And okay, first look at Pfizer. I want to look at Moderna too, but Pfizer, I think more of you have Pfizer than Moderna. Pfizer is still considered a blue chip stock. So Pfizer, a couple of weeks ago, was just about $52 a share. Okay, It's high, 52. And now it's 42. I mean, that is a big drop, just about a 20%, almost a 20% drop on Pfizer in a very short period of time. And people really getting excited. They saw Pfizer go from 42 to 45 to 48 to 50, starting to buy Pfizer. The problem is that the world is awash now in COVID treatments. And if you take a look, let's do the same thing with Moderna. Moderna was almost 500, and now it's 324. I mean, just like a week ago, it was 400, and now it's 324. Continues down, almost down about 4.5% in today's trading. Just continues to tank, down over $15 today. And now you have the Merck drug for COVID. The Merck drug is an antiviral. Think of like Tamiflu, right? Except Tamiflu doesn't work for COVID. Tamiflu is a flu drug. That's why we have use the word Tamiflu. But Merck's drug goes like this: if someone in your family is exposed to COVID in the nuclear family, you all live together. Dad comes home, he's infected with COVID. All right, we test positive for COVID. Everyone else in the family would take this oral drug from Merck. Everybody takes it. I don't know how long the regimen is. And everybody should be okay because this drug stops the virus from replicating in the body, kind of like what Tamiflu does with the flu. So a lot of people are thinking, well, if I haven't gotten the vaccine yet and I'm exposed to COVID or exposed to somebody who has COVID, I'll just take this drug. Well, first of all, the drug hasn't hit the market just yet. And by the time you do get the drug, you could be exposed to the virus, and maybe the virus starts to sink in a little, like starts to make you sick, not just like the initial exposure where you don't even know you have it and you're still asymptomatic, because it takes a few days for the virus to start to really affect you. And then you're taking a pretty big chance of that, because then the virus could get really bad very quickly. And a lot of people who are exposed to COVID don't even know that they're exposed to COVID, or they don't get tested because they feel like, oh, I feel fine. Why should I bother getting tested? If I have a sore throat, I don't feel well, then I'll go get tested. A lot of people wait till they're really feeling crappy to get tested. And at that point, you cannot take the Merck drug, because the Merck drug, the antiviral, only works at the very earliest stages right after exposure to COVID. So it's not a cure-all, okay? Not by a long shot. But in any event, with so many people in this country having had the Delta variant and getting vaccinated, and vaccination, new infections are plunging, we have something really good to look forward to, and that's the reopening of the economy. We've seen that in the beginning of the year. It's been put off, and here we are. But we've got the debt ceiling to get through. Now let's talk about the debt ceiling. Do you know what the debt ceiling is? We've got a couple minutes, so I try to keep these shows to a half hour. The debt ceiling isn't about borrowing more money. Okay, that's not what the debt ceiling is. No more borrowing. We're not raising the debt ceiling. The debt ceiling basically works like this. It's to pay for the expenses that the United States has already incurred, to pay for the, I don't know, $8 trillion of government spending in 2020 because of the pandemic. It's to help pay for what has already been done, not for new spending. And you give an estimate. You say we're going to do a lot of spending in 2020. When it might come out to more than we expected, which means the debt limit has to be raised a bit because we miscalculate a little bit. So we raise the debt limit and we pay the bills. This means we pay interest on Treasury securities. The United States has never defaulted on a Treasury security. The Treasury security, and by default, the US dollar, are the reserve securities and reserve currency of the world. It sure would be a shame to lose that status, not because of an ego thing, but because the United States enjoys lower interest rates. It enjoys an easier worldwide footprint for business, and so many other things because it has the U.S. dollar as the world's reserve currency. You don't want to mess with that. You don't want to lose that. You don't want to play with that. So raise the debt ceiling now, and then start talking about raising the next raising it again now. Don't wait till the last minute to do it. But unfortunately, there's so many things to do that people wait till we're in crisis mode to do something. And this is why you get that expression, never let a good crisis go to waste. But the debt ceiling has to be raised. Okay, so what else? Earnings. Okay, yeah, big one. Third quarter ended with September last week. Starting next week, we're going to start getting earnings, earnings, and earnings. It's going to be earnings central here for a while. And we need to see what CEOs and CFOs forecast for the rest of this year, for the for the quarter we're now, Q4, and for next year. They have enough visibility for next year. Is the economy really slowing down that much? Do we have to lower our earnings expectations, which means the stock market has to be taken down even more? That's a very big deal. That's a huge deal. We have the non-farm payroll figures coming out on Friday. We're expecting something like 475,000 jobs. The month before, the August payroll numbers that came out last month in September were a dismal disappointment. But we need to see, is the retreat in the number of COVID infections starting to allow more job creation in lower end sectors in travel, leisure, restaurants, that sort of thing. So it's a big number. Every number is every time we get the non-farm payroll, it's the biggest number ever. And I expect Friday's number to be no different. All right. What else are we looking at? OPEC, oil. Let's take a look. Let me just tell you where oil is. Okay. So Brent, there's two oils. There's Brent, which is like the global oil benchmark, it was in the 80s now. It's $81.27. And West Texas Intermediate, that's the crude that comes from the United States, from Texas, from Oklahoma, from California. That is $77.60. Okay. 77. Can you believe how high oil is now? Weren't people just saying recently that, when oil was down to like the mid to low 60s about a month ago, that we're not going to use oil anymore? So here it is. Oil is in the high 70s, low 80s between West Texas Intermediate and Brent. OPEC just had a meeting today, and they said they're going to raise production because, OPEC plus, that's OPEC with Russia, has been really doing a good job of limiting the amount of oil that they put on the open market. But in November, not now, in November, they're going to raise daily production quotas between OPEC and Russia an additional 400,000 barrels a day. Is that enough to make a difference in the global price of oil? I really don't think it's that big of a deal unless OPEC members cheat. But with technology and everything, it is harder for OPEC members to cheat. They really have to just say, screw it, I'm going to pump out whatever I want, and then you'll see oil come down. But oil continues to go up. The rebound is there, and that's why energy stocks have been doing so well. And people gave up on energy stocks. This is why we say diversification. That's a strategy we use to minimize downside risk, but it doesn't necessarily protect your portfolio from a generally down market, right? But that's why you want financials and energy and other stocks besides just the tech stocks, okay? And if you got carried away with the tech stocks, you're feeling the pain right now. If you got carried away with the high growth stocks, you're just feeling pain all over the place, okay? So what else? Earnings we covered. OPEC, NASDAQ versus NASDAQ 100. Okay. Okay, now we have to talk about this. This is the last thing we're going to talk about in about a minute, okay? Know what you own. Knowing what you own. We spoke about this a little bit last week, but when I say know what you own, the first place to look is this. Are you comfortable now that the market's volatile with more downside than upside lately? Are you in individual stocks, or are you in stock market products like exchange traded funds and or mutual funds. If you're in individual stocks, presumably it means you're less diversified, more concentrated in your equity holdings, your stock market holdings. Okay, when we say equity or equity market equity holdings, just substitute equity for stock, and there you go. Just for some reason on Wall Street, we rather say equity holdings than stock holdings because we think we're fancy. But you and I, we're simpatico. We are one and the same. You and me, we are on the same page. Okay, so if you're in individual stocks as opposed to exchange traded funds and mutual funds, you really need to do a personal risk assessment for yourself to make sure you can handle the volatility and even the risk. Risk and volatility to me are different things. Okay, but risk means, like, let's say you're in a tech stock that has had a unique set of circumstances, like a pandemic, that pushed up screen stocks, the stocks that you look at, that make products and services that you look at, that enabled us to work from home and stay at home. And the economy reopens, and the environmental factors that contributed to the outperformance of screen stocks disappears, and then the screen stocks go down. You have to ask yourself, will there be another time, another unique set of environmental circumstances that will cause the screen stocks to rebound and go up to new highs? These are the kinds of things you have to ask yourself. And either you're being flexible and owning both reopening stocks and tech stocks, or you are nimble enough to sell tech stocks and go into another area. But if you're not sure of what to do and you're not sure how to handle the risk and you're not sure which trades you need to make, then I'm saying that your risk tolerance probably is not where it needs to be in individual stocks. So that's one of the things that I mean when I say make sure you know what you own. All right, we're at 32 minutes, so I'm going to break up this party. I'll be back tomorrow. It's been a good show. Thank you for sticking with me. Hope you enjoyed it. Give it a thumbs up or an applause or something. Let me know you're there. It helps the algorithm, and I really appreciate that. That's what all the YouTubers say. Like they love to say that. It helps me with the algorithm. Yeah, okay. We'll see. All right, I'll see you tomorrow. Thank you.